Stocks climbing yet again, putting the S&P 500 and NASDAQ on track for their 8th positive session in a row, their longest winning streaks this year. Our next guest sees a few positive signs for even more upside. Nick Colas, DataTrek Research co-founder, he joins us now. It's good to see you. Welcome back.
Thank you.
You're pretty positive on these markets here?
Yeah, it feels pretty good. We had a bit of a shuffle 2 weeks ago, but that volatility has died down, and now we're reestablishing the same trends that we had in July. So the cyclicals are leading, small caps are leading, and that's good to see.
No volatility is going to reemerge. I mean, was that just a one-time fit? Some are suggesting otherwise.
Look, volatility will always be with us in some form. It never is absolutely quiet, but August tends to be one of those months where volatility peaks out for the year. It's about twice as likely to peak out in August as the typical month of the year. So we've just seen a big volatility storm. That was probably the peak for volatility. Are we going to get some more? Yeah, absolutely. We always do, but nothing on the order that we saw 2 Mondays ago.
Yeah. What about Jackson Hole? The market seems to be expecting a lot from the Fed here forward. What's the risk in that?
Yeah, you're right. There are pretty high expectations. We went back and looked at how markets perform around Jackson Hole. So the week before the Fed chair speak and the week after the Fed chair speech. And what we found is that markets tend to rally through both, but they've definitely weighted towards the back end. So markets do better after the speech, after they hear what they need to hear from the Fed chair. So the returns tend to be skewed towards next week versus this week. And I think we're going to see the same pattern emerge now. Powell should bless a 25 basis point cut in September, at least in principle, and that's what markets want to hear right now.
But that's got to be already in the markets, right? Is that enough?
It's funny. You would definitely think so, right? Because that's what the chatter is, and that's what Fed funds futures indicate. But there is always uncertainty around these speeches. That's why the market tends to trade up a little bit into them and more after them, because they actually want to hear the words and they want to hear how it's said. So I'd say 60% of it is in the market right now, but the market still wants to hear the words, and that's what we should hear on Friday.
You like cyclical stocks here, correct?
Yes.
Why so?
So right now, I think we're in what we'd call a mid-cycle market. We're in the part of the economy where the economy is expanding, where there's no obvious recession risks in the offing. The Fed is about to begin reducing interest rates, and that's a classic mid-cycle market setup. And if you go back to every mid-cycle market from the 1980s till now, four groups tend to trade off leadership over the course of a mid-cycle rally, which can last years. On the growth side, it's healthcare is defensive and technology is more offensive. And then in cyclicals, it tends to be financials and industrials. And those four groups trade leadership back and forth over the course of years. We saw the tech rally happen in the first half of the year, supercharged by AI, obviously. And now we're seeing the cyclical rally come into the second half of the year with financials and industrials leading. And that's true for both large caps and small caps. We're seeing the same kind of leadership emerge across market cap ranges, which confirms that what we're looking at is correct.
Yeah, but you say that the economy is expanding, which, okay, it is. It's not contracting, but it's slowing. The numbers are kind of undeniable in that sense, which is why some figure we're in late cycle, not mid. How do you respond to that?
Yeah, I mean, look, mid cycles are not painless rallies, right? This happens every mid-cycle. I've seen every mid-cycle since the 80s, and it always happens this way. You get a period of growth, and then there's concerns. There's always concerns, but you need a true catalyst to end the cycle. For 1990, it was the Gulf War I. In 2008, it was a financial crisis. In 2020, it was a pandemic crisis. You need a clear and present catalyst to truly end the cycle once and for all, and I don't see that catalyst forming. I do agree with you, they're slowing, but that happens every mid-cycle. We have periods of better and slower growth, but we shouldn't freak out and worry that, oh my God, it's the end of the cycle just because we have a few weak data points.
No, but I mean, if you think a recession is possible in the next, let's say, 12 months, that doesn't necessarily portend a mid-cycle market, does it?
It doesn't. But again, you have to think about what is the catalyst? What's the call behind that recession call? Because we're going to have the Fed lowering rates. That'll lower the cost of money for consumers and businesses. We still saw, as we saw last week, strong retail sales demand. We track weekly gasoline consumption, and that's still good. That's now up year over year. So there's plenty of positive points as well as the negative points. And I'm not overly worried that we get a slowdown that results in a recession. Are we getting a slowdown? Absolutely. Labor markets are slower, but they're normalizing after a really long period of way above average growth.
And lastly, you like small caps as a result of that view?
Yeah, small caps are always a trade to us, never an investment. You want to be long small caps for 10 years, but there are periods when they work. And this is one of those periods, particularly because high yield spreads absolutely blew out 2 weeks ago. And they kind of hovered around high levels for a few days. Now they're coming back down again. And small cap stocks really rely on access to affordable capital in order to complete their growth plans. And as high yield spreads decline, which they're doing now, you should see small caps continue to outperform. That was the pattern in July. I think it'll reestablish over the next 4 weeks as well.